Okay, we're kind of focusing a little bit on the more luxury end of the market because we're talking about a company first, Daimler AG, which is, of course, the big German Daimler Benz manufacturer. They've got the cars. They've also got AMG, which is their sort of specialist souped-up division. Nick will tell us about that. They're quite big in trucks, motorcycles, and all that sort of stuff as well, buses, and then the financial services businesses. All of these have, like, money lending operations to assist you in buying the vehicles. 73.6 billion euros. That's about $80 billion. Big company. Price to earnings ratio 7.5. That's not very generous. Dividend yield of 4.7. That is generous.
That's not bad. Yeah.
Let's go straight to the share chart because that will show you how they're doing. You'll see a little bit of an uptick at the end on the far right, reflecting, I think, the optimism about Europe and the outcome of the French election and so on. But give us a more general sense how you feel about this one.
Okay, so Daimler will be one of your more traditional car companies in the sense that it's alongside with BMW and Volkswagen and Ford and General Motors. So the sense here is that these are very highly capital intensive business. A lot of money is spent on research and development.
Yep.
And very importantly, competition is extraordinarily fierce. It's quite easy to switch your Merc for a BMW or for an Audi or for a Lexus. So they're continuously fighting each other for market space. And that fight comes with new product developments and new product launches.
And lots of marketing.
Very, very expensive. So you need to get the cycle right on these companies because that's what they're moving. They're incredibly cyclical businesses. So for example, we see on the graph here that we've got a bit of an uptick on the Daimler share price, mainly due to all the new product launches that they've had. They released the new C-Class. They've recently released the new E-Class. They've done incredibly well on the GLC. It's not starting to come to a little...
GLC is like the sort of SUV, larger
Yes, it's like that little crossover SUV. You've got the bigger ones as well, like the GLE that I see around in Santon quite often. Beautiful cars, absolutely nothing wrong, but it's kind of, that's in the past now. It's now having a look at what are their competitors launching.
But clearly the mass has got to be the C's and the E's because that's really where the most of the sales happen.
Absolutely, and that's why the new E-Class that was launched late last year, but now coming into this year is going to be very, very important for them. But I think generally having a look at the figures, having a look at the outlook, these typical car companies generally have a very low PE of sub 10. They generally have a pretty good dividend yield.
And that's because of the volatility in earnings through the cycle. People worry a little bit that they've got to get the launches right and that the market's got to be receptive and that the cycle in consumer demand's got to be
So you can't just think, oh, it's a cheap share. It's great dividend yield, a great PE. There's a lot of risk that comes with traditional motor vehicle businesses.
Let's just remind viewers, though, that in the past, Daimler owned Chrysler. They don't anymore.
Yes, they
bought it in 98. They sold it again in 2007.
Disaster.
It was a bit of a mix-up, bit of a mess. 2007 wasn't a good time.
Not at all.
Dieter Zetscher, the guy with the big, beautiful moustaches, is the CEO. He's been there a long time, knows what he's doing. These guys are great. They're innovative. They're extremely solid. They can do it all. They don't own that stake in Airbus, EADS, that thing anymore. They had like an aerospace division. That's all gone.
It's a much more pure business, essentially. There aren't all these other peripherals that they own. Yes, they've got a small interest in Renault and a small interest in Nissan, but specifically it is the Merc.
So we're positive on Europe. We think the Euro project and the Euro currency is going to stay put. The cars are going to be in demand. What's not to like at a low price earnings ratio?
I think what's not to like, I guess, would be the the availability of other car manufacturers. Do you look at a Daimler, and this is where it gets back to my my cyclical point of view, is that the share price is directly linked to the availability of new vehicles. So if Daimler's coming to the end of their cycle now of replacing all their old vehicles, are we going to see the same kind of cash flow and increase in margins going forward? And I don't think so. What I'm trying to say here is I'm trying to say that the share price recovery that we've seen over the last year or 18 months, I think is going to reach a bit of a top level. And when you're getting close to about 70 euros, where I think it is at the moment, or 68, you're not going to see much more, in my opinion, than about maybe 75, maximum 80. So I'm a bit cold on Merc at the moment. I know you drive a Merc, so it's not a personal push here, but from a share price perspective...
my car's a 1993 model, so I don't think you can say that that's going to have a big impact on sales.
Okay, no, but still, it's one of those interesting things. So
you're going to tip not hot on this one?
I'm not hot on Daimler, but wait, when we get to BMW, things might look a bit different.
Okay, I'm going to go with hot on Daimler. I'm thinking this one looks just too
It's just because
cheap.
you own one, that's it.